Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. In this session, let us understand what is bank guarantee, its meaning, purpose and nature. First, let's get into the meaning of guarantee. Guarantee is basically a contract to perform the promise and to discharge the liability of a third person in case of a default. And this is what we have in section 126 of Indian Contract Act 1872. So, guarantee is basically a contract where you are going to perform the promise because you have made a promise that if third party is not going to perform, then you would perform. Okay, so it's basically a contract to perform and discharge the liability of a third person in case of a default. So who are the parties involved in bank guarantee? Basically there are 3 parties. 1 is applicant, 2 is beneficiary and 3 is guarantor. Applicant will be bank's customer. Beneficiary is the person in whose favor bank guarantee has been created, or say the guarantee is given, and guarantor is generally banker. Now let us also understand the nature of this contract, that is guarantee. Whether this contract for guarantee is a primary contract, answer is no. The nature of guarantees are collateral. It means they are consequential to the main contract between the applicant and beneficiary. It means there will be a contract between applicant and beneficiary, say for some exchange of goods or for rendering of services or for some fulfillment of promises. And if that contract is not executed, then this guarantee contract comes into picture. That's why we say guarantee is collateral in nature. Now let's say bank is going to give guarantee in favor of a beneficiary on request by applicant. What is the risk bank has with regard to guarantee? See, risk arises in the event of default by applicant. That is, applicant is supposed to perform some promise or make some action and he is not doing that. Then if the default is brought to the notice by beneficiary, then the guarantor should perform the promise. But if the guarantee is given by the bank, then bank will not perform the promise. Rather, bank will compensate the loss that was suffered by beneficiary on account of non-performance or non-fulfillment of promise, and this compensation by the banker will be restricted to originally guaranteed amount. So understand, very important. Okay, in the event of default by applicant, the default has to be brought to the notice by beneficiary to the guarantor, and guarantor is only going to compensate the loss. Okay, it's not that guarantor is going to perform the promise here when bank is a guarantor. Understand that. Okay, also understand, when beneficiary makes claim to the guarantor, that scenario we call as invocation of guarantee. If you are a contractor, you will be getting most of the business by participating in tender. If you are bidding against the particular tender, then you may have to submit a deposit. We call it as earnest money deposit. Instead of that deposit, you can also submit a bank guarantee, and that bank guarantee is called as bid bond guarantee, and they will be generally up to 5% of value of contract for which tenders have been invited. And if you look at the expiry date, it will be fixed and it will generally match with the date on which bidding process is expected to be completed and the date on which contract will be signed with successful bidder. Okay, right. So once this bidding process is completed, the bonds will be returned to unsuccessful bidder, and successful bidder will be called to sign the contract. In case if successful bidder is not signing the contract, then the organization which has called for the tender will invoke this bid bond. Okay, so we can say bid bond is more of performance guarantee, and here the assessment is focused on capability of the contractor to take up the contract which he is bidding. Okay, and in general, bidder will win a contract only after bidding many tenders. So it is possible that the number of bid bonds and amount involved in those bids will be beyond the capacity of the contractor if he is going to win all. Okay, so it's okay sometimes despite winning, if he is not taking the contract, it's normal and it's not a worrisome situation. If a contractor has completed his job successfully, let's say to the satisfaction of the employer, then automatically all guarantees should come to an end. But certain employers would try to act safe because they do not want any fault or mistakes to crop up after work completion, and they do not want to suffer any loss. So what they'll do is they will insist on a guarantee for maintenance period. That would be basically the period after completion of the project, and generally it would go up to 1 year. This guarantee would give them protection against faults which are discovered after project completion. When these faults are identified, the employer will call the contractor to rectify, and if the contractor is not going to rectify it, they can invoke the bond, get the money from the bank and get it done by someone else. Okay, so this maintenance bond is generally given for 1 year period, and maximum it will be like 5% of value of the contract. In banking, you will come across customers who are undertaking construction contracts. While these contractors receive payment from their employers, certain percentage of the payment will be retained, and generally it will be like up to 10% of each and every payment. That retained portion is called as retention money. But the problem with retention money is that this is going to affect the cash flows or liquidity of the contractor. So what's the solution? Whether employer will compromise retention money? Answer is no. Employer will not compromise retention money, because once the contract is completed and if a defect is identified, then that defect will be either adjusted against the retention money, or contractor have to rectify the defect to get back the retention money. Okay, so that's the very objective of retaining portion of payment. So they are not going to agree. So what's the alternative option? In most of the cases, employer will accept guarantee instead of retention money, and this will be equal to retention money in general. This guarantee will ease the liquidity in business, and when this retention money guarantee will expire, it will expire when the project is completed, that too to the satisfaction of the employer. But of course, later on this retention money guarantee will be substituted with maintenance bond or maintenance guarantee for some more period. That is, after completion of project, generally it goes up to 1 year for maintenance period. In banking, you will come across customers who are taking up big projects, turnkey projects, construction projects, mega export projects, that too all involving high cash volume. These customers will be requiring advance payment from their buyers to execute the contract. That's basically for purchasing materials, paying laborers and so on. And for this, they also would have entered into an agreement with the buyer. But buyer will be making this payment only after the seller provides him some kind of a guarantee. Okay, that's where this advance payment guarantee comes into picture. If seller is not going to deliver the product or render the service after collecting advance, then the buyer can invoke that advance payment guarantee and get back that advance money whatever he paid from the bank. Okay, so whenever advance payment guarantee is issued, it is very important that it is tracked very correctly, because if invocation arises, its consequence will be worse than default in fund-based facilities. Okay, so how it can be tracked? Probably you can insist on a cash budget. By having a look at the cash budget, you get an idea how this advance payment is going to be utilized and what will be the impact if the need for repayment of advance payment arises because of invocation. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far, I have introduced 7 courses of 1999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral security is a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course. The link of the course I have given in the next lecture. So once you complete this video, just move on to the next lecture. You will find the link. Click enroll. I'll see you inside the course.